everyone, and welcome to a special episode of Buy Now, Sell Now on campus with me, Avan Dabash. As a proud alumnus of Jai Hind College, I'm glad to be back here for a special episode. Today we have the students of BMS as well as BAF joining in, and our very special guest who will be guiding us over the next 30 minutes. We have with us Manish Gunwani, who is the Deputy CIO of ICICI Prudential AMC. Thank you so much for being with us. To start off with, I was going through some of the notes that you gave us, and you were talking about when you invest into the markets, you need the ideal relationship between price, fundamentals, and value. Can you elaborate a little bit more on that?
Well, basically what I'm saying is ultimately you're competing with a lot of people on the street when you buy a stock, because obviously others have a different opinion on it. Yeah. So when you're buying a stock, there are obviously a lot of people wanting to sell it. So the point I'm making is that when you buy a stock, first of all, you have to realize it's a very, very competitive field, right? Everyone wants to make money. Everyone is working hard when they're investing. So when you want to buy or sell a stock, you need a perception and insight which is different from the street, what we call a variant perception, because obviously unless you have that, you're not going to stand out from the street and do better than the market. Now, this variant perception can be of various types. One is behavioral, in the sense that if a company is worth X, but due to some issues, its profits have fallen and it's going through a very tough time, it'll start trading first at 0.8x, then it'll start trading at 0.6x. And it's not rocket science to figure out that the stock is cheap, but it's just in the herd is selling. It's difficult for people to go against the herd and say, look, I think this company is undervalued, I'll buy it.
But that's advice that you would have, that go against the herd? Is that what you're saying?
So that is, most of the times value is contrarian, but like the Seth Klarman quote I sent you, value investing is being contrarian but with a calculator. So sometimes there are genuine value traps, right? So if you bought a fax machine company stock in 90s, you can't say it will mean revert. So in that sense, you need to also have some numbers, some insight into the business, that it's not falling because of genuine reasons. So if Kodak is down 1/3 and you buy Kodak, you're going to really make a big loss still, because the stock will go to zero eventually. But yeah, most of the time we've seen that you need a combination of behavioral strength and insight into the business. When you combine those two, you typically get a perception which is different from the street, and that's where you make money.
Let's talk about what you were like in college. Were you a backbencher or were you sitting right in front?
Pretty much a backbencher.
Backbencher. So there's potential for all you guys sitting at the back then. That's where you'll end up. Okay, let's open the floor as well to the students here and see what kind of questions they have for us. I believe we have a question from you.
Hi sir, my name is Upamanyu Acharya. I'm a student of BMS. So my question is, there's a growing consensus within Silicon Valley and New York and London that tech startups are especially inflated right now. So would you say that translates over to India?
What we're seeing today is, even here the startup scene has got impacted, but I think the reasons are very different. I think if you look at tech startups in US, they're genuinely IPR related business with non-linear business models. So I would probably hesitate more to be critical of their valuations, because if you're a business which can go from X to 10X without your costs going up in the same proportion, it's very difficult to value. So we've seen Apple, I mean 10 years back it was probably 1/8 or 1/10 the market cap, and at that scale the market cap accretion has been one of the fastest in history of economics, because it's a very non-linear business model, right? Because you have a lot of IPR, you have iTunes and all that stuff. The problem I have with a lot of so-called tech startups in India is they're very copycat models which are not IPR led. So if you're not IPR led, then basically you're not non-linear. See, a linear business is always easy to value. So if you take a company which is into IT services, for example, you have 100 people, they will do X revenues. If you have 1,000 people, you will do 10X revenues broadly, maybe 5-10% here or there. And then it's easier to value. You can do a DCF and all that and just come to a fairly approximate value of that company. Where it becomes difficult, as I said, is someone who's discovered, let's say, a new drug for cancer. Now, obviously, then it becomes very, very difficult to value that kind of company. Frankly, I don't see too many of them in India at this point of time. So the tech startup in India is these e-commerce things which are actually copycats of a lot of US business models. Most of the business models in India are just, rip-offs of what's happened in US. So I would be a bit more cagey about the Indian models rather than the US models.
I just want to come in then and talk a little bit about the markets. Given the kind of roller coaster ride we've been through so far, things have been going up. What is the outlook for the equity markets going forward? What do you think are going to be some of the key triggers?
So I think, first of all, we get the sense that things have been going up, but if you see last 2 years, calendar year 2015 and 16, cumulatively the Nifty return was broadly zero. So it's on a 3-year basis, it's not that the markets have delivered spectacular returns. What has happened is due to a host of factors. If you see the ROE of corporate India on an aggregate, it has actually come down to 8-10-year low. Now, there are a mix of structural and cyclical factors for this. The cyclical factors, we all know world economy has been soft, Indian economy has been soft. But I also think there's a bit of structural element to this in the sense that, for example, the pricing of natural resources, I think has structurally moved to a model where it's market driven rather than a allocation model. See, a lot of profits were made when things like coal spectrum were allocated and not bid for, because obviously the cement companies, the mining companies got a lot of these mines at pretty cheap rates historically. But since last 10-15 years, due to this whole ecosystem of governance and transparency and RTI, etc., today if you want to buy a coal mine, you will have to go and bid in an auction. And what an auction does is basically take away the surplus the company was making, because if you have to pay market rate for coal and all the other natural resources, you obviously your high ROE which you were making because coal was cheap is gone. So I think what has happened is the ROE has come down. So on price to earning, the market looks a bit expensive, but on price to book or replacement cost, it's not that expensive. So my sense is if we get a cyclical rebound in global growth or domestic growth, I'm not of the view that the market is super expensive at this point of time.
Okay, that's a view on the long term. You have another question for our expert?
On November 8, 2016, government took a very different step like demonetization. How it has affected the Indian companies and which are the industries which are affected the most?
Yeah, because we've seen quite a bit of a slowdown, so that's, quite a great question. But Manish, we've been talking to a lot of corporates and from different businesses, and they seem to say that, the worst is over and things are likely to stabilize. Should we buy that?
I think so. Very simple terms, see, demonetization to a very small extent keeps happening all the time, because whatever soil notes you have, you go to RBI, they'll replace it with new notes. Now, obviously, this happened at a great scale, but for a few months, it was going to have an impact, and it did. But after 4-5 months, I think you've just replaced the old money. If you see the money in circulation today, it's roughly gone back to about 12.5-13 lakh crores. It was about 17-18 lakh crores at the beginning of the year. And I think there was obviously a lot of inactive money in the system, which was a combination of two things. One was the black money, And two is, even in our houses, if you notice, we do keep some money which we've forgotten or which we don't use that actively. So if you adjust for that, basically we are back to the levels we were at the beginning of the year, and therefore I don't think it's going to have any great impact in the long term. Now, in the few months when the money is being replenished, you did see a lot of pain in transactions. Big cities like us, we saw it only for 2 months. I think the rural areas are still probably seeing the last of that, but it's just like a bad monsoon, 2-3 bad months and it's over. I don't think it has a very great effect in the long term.
Okay, tell you what, we'll slip into a short break right here on the show. Come right back. We're at the campus of Jai Hind College in conversation with our guest on Buy Now Sell Now campus. Stay tuned. Thanks so much for staying on with us. This is Buy Now Sell Now on campus at Jai Hind College, and with us we have Manish Gunwani, who is the Deputy CIO, ICICI Pru AMC. Well, Manish, you know, being back in the classroom will probably bring a lot of memories, and a lot of these students here, I'm sure, will be first-time investors. Tell us, any classic mistakes you made when you first invested into the equity markets?
Yeah, actually, I mean,
what was your first
stock I bought was a urea manufacturing fertilizer company, and it looked damn cheap on price to earning, it looked damn cheap on price to book, it had a good dividend yield, but I kept it for 2-3 years and it just didn't work because since the prices of the product were regulated, the market just never gave it a high price to earning multiple, and while the stock just kept giving dividends, it was just not good enough. I mean, it didn't deliver any great return, and kind of led me to wonder what P is all about. Actually, when we do investing, there's supernormal attention paid to the profit and the earnings growth, but really the tricky part of a market is to figure out what price to earning multiple that stock deserves. Even today I struggle with that because there are stocks where clearly next 3 years are bad, but there is exponential growth after next 3 years, and the market is ready to give it a high P, saying that we'll tolerate these next 3 years, but there are another stock which has the same profile, but the market would say, look, I don't believe anything is going to happen, so I'll just wait for the earnings growth to come.
So the learning curve still continues,
yeah, the learning
when it
curve
comes
still
to
continues,
that.
yeah.
Good afternoon, sir. My name is Haura Lukmanji and I'm a BFM student. My question would be, we all know Japan is a strong economy, but however, we see that the currency rate of Japan in relation to the Indian rupee is quite low. So what is the reason for that? And also, why would Japan go into the negative interest rate scheme? What is the motive behind the entire system?
So just like in a sense, bonus shares don't have any meaning, right? You can divide the number of shares of a stock into 2 and the stock price would halve. Frankly, the nominal exchange rate is of no great importance. Basically, it's just about how much value of money is there in circulation in the economy, and whether that amount of money, is it creating macro stability, is it creating growth, is it creating liquidity for the people to transact. So as long as you see a current account deficit in order, inflation in order, then you don't need to bother whether yen is 100 or 1000 or 10 to 1. It's just historical how they have printed money. So just because yen is 112 doesn't mean it's a weaker economy. Just like a stock of 50 rupees is not cheap versus a stock of 10 rupees or 100 rupees. I mean, the nominal value frankly doesn't have any great importance. As far as the negative interest rate regime is concerned, now that is something all of us are grappling with, because obviously in economics 101 you're taught that money has time value. So a rupee today is worth more than a rupee 1 year later, and it's difficult to unlearn that, difficult to see how negative interest rate will work. But I think what we are kind of grappling with is these kind of demographics, these kind of debt, we've never seen historically. So if you study economic history, Japan has cumulative debt of about 350% of GDP. Now these are very mind-boggling numbers. I mean, 50 years back, 100 years back, there is no way you could have modeled these kind of numbers. So I don't really have a precise answer to this, where these negative real interest, negative rates will end up with. But even for us as observers, it's a very interesting period where you're seeing that you have a country where the number of elderly people is outstripping the people who are earning money. You have a country where there's so much of debt, 300 odd % GDP, but still that country has a bond yield which is almost 0%. This tells you that basically if you see any financial architecture, the foundation is just trust. So I wonder why would anyone in Japan put 10-year money and earn 0? But I think it's all just down to trust. They just trust that this money will come back. I think it'll be interesting to see. Frankly, I don't have great answers to that question yet.
Yeah, mind-boggling questions. They've got all of they're asking very foxy questions. So let's come across to you. What do you have to ask, Manish?
So after the Vodafone merger confirmation, the price of Idea declined like really good. So what's the negative impact about the merger confirmation? Is there on Idea and not on Vodafone?
Again, I'm not sure that.
But you know, Manish, but let's just come to the telecom sector as a whole, because you can't help but ask about that. There's heated competition. There's so much going on within this space. What would be your outlook?
So from a medium to long term perspective, actually we are positive on the telecom sector. As I said, a lot of times the value is created when the others are viewing it differently and you have a different view. So are
you saying that the competition within the space is healthy?
So our view broadly derives from the simple economic algorithm that no industry can perpetually lose money. Ultimately, people will obviously exit that industry. Some capacity will exit and the remaining capacity will start making money. Now, obviously, the luck or the tricky part of all this is whether it happens quickly, because quite clearly the earnings will be on a weak trajectory for a fairly extended period of time. But we do think that if you've got consolidation in the industry, which seems to have happened, at some point the players will come to a point where they will price it to make a decent ROI.
And I just wanted to understand your outlook. I was looking at your top sectors. You like pharma. Why is that?
Again, that's a sector. First of all, we generally like domestic businesses versus international businesses, because obviously India is a place where you're going to have the highest nominal GDP in a major economy for a long period of time. So if you have a business which is focused in the domestic sector, typically it tends to exhibit higher long-term growth versus international businesses. So a lot of these pharma businesses, see, they've gone through a rough time because of the US business part, but a lot of them also have a very strong India and emerging market piece, and we think on an aggregate the sector is undervalued at this point of time.
Hello sir, my name is Manjot and I am from BFM. I had a doubt that people are going bearish in the market. Is it due to the GST? What has the negative impacts of GST on the people going bearish in the market? I heard this news today that people are selling stocks in the street. So what are your views on this?
So from a long term perspective, obviously GST is very good for the economy. There is a thought that in the near term it could be negative for the economy and negative for earnings. The reason being that it imposes a lot of changes on regulation. So the filings you have to make, any company, the filings it has to make, the software it needs to install and configure will take time. So there might be about 3-4 months where the whole value chain in a lot of industries will get impacted. So for example, if you are a cement company and you're supplying to a cement dealer, now that cement dealer may need to make a lot of changes at his end to comply with GST. And in those 2-3 months, he may choose to stock very little inventory of cement, which means you as a cement company may have to cut down production, which will hit your earnings. So there is I would think anywhere between 3 to 6 month impact of this transition, which may impact earnings in some manufacturing sectors mostly. But I don't know if the market will really be bothered about it too much.
Let's move on to the last question then.
Hi sir, I'm Satya. How good do you think is a mutual fund investment? Do you think it's advisable to start with mutual fund investment at this point of stage in our lives? Because it's less risky, as I know.
You're asking an interested party. No, honestly, I do believe that just objectively, if you look at data, not only mutual fund, first of all, I think equity as an asset class is a brilliant way to invest, because you look at any time frame, decent time frames, 5 years, 10 years, 20 years, broadly the index would be anywhere between 13 to 15% compounding return. And this I've learned at personal cost. Whenever you invest in property, gold, etc., one is the returns part. Now, obviously equities tends to outpace the other asset classes, but the sheer convenience, the taxation benefit, the liquidity it offers just beats any other asset class hands down. I mean, if you invest in property, believe me, the bandwidth you need to manage that, the transaction cost, the liquidity issues are so enormous that I would think that if you have a structured way of investing in equities, it's almost a mandatory thing, because nothing else will come close to it. And of course, if you're not a finance professional, then obviously mutual funds are the way to go for you, because it needs a decent amount of time, bandwidth, expertise, which institutions can provide.
And on that positive note, we would like to thank you, Manish, for taking time out and joining in. It's been great having you with us. You guys have been a great audience. I hope you've taken down lots of notes. And with that, it's a wrap from BNSN on campus.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.